Good morning. Good morning. How is everyone? Great.
But I push and sail.
Is there any other way to roll, Harold?
You talking about his eyes or his tail?
Easy, yeah, easy.
I think it's a package deal somewhere. All right, good morning, everyone, and we're just after 9 o'clock. I thought I was right on time, I apologize. Why don't we start this morning with a roll call? To open the meeting.
Governor,
Yep.
there's the phones are ringing.
Okay.
Governor Michelle Lujan-Grisham,
Present.
Peter Frank,
Here.
Secretary Olivia Padilla-Jackson. She had informed us that she was going to be absent from the meeting. Linda Eidson. Here. Tim Jennings.
Here.
Harold Lavender.
Here.
Treasurer Eichenberg.
Present.
Commissioner Stephanie Garcia-Richard.
Here.
Lee Rawson.
Present.
Scott Smart.
Here.
And Linda.
Present.
Yeah.
We have a quorum. Terrific. Good morning, everyone. All right, next on the agenda is to approve the agenda. Yes, sir, Senator.
So, but
I have a question as to whether or not we should move item 5 to the first of the agenda.
Is there a reason?
Well, it just seems like the more important part of the discussion, and everybody's here.
I'm happy to do whatever the council
I
wants
just
to do.
wondered why it got placed like last instead of.
There's no reason. People stay here the entire time. We do the briefings. This is typically the order that we do the agenda. They follow that exact order, so there's no rhyme or reason except go forward standard course. And if you'd like to move it to the top of the agenda, Senator, and that's a motion, then I would entertain a second.
Well, I just throw it out there for discussion. I'd rather see
Okay.
those types of things farther up in the agenda, and if everybody's prepared for it to be there, that's fine, doesn't matter, but I just like to see that type of thing elevated.
We can do that in the future. Senator,
Is there significant public notice of that?
there is.
I mean, I understand maybe legally, but I don't know if that's, you know, it just seemed to come on at the last, I didn't know.
I would submit this to the council. For a decade, these issues have been in the public eye, it should be. There has been incredible litigation efforts, and there should be. And the public has been well informed, and they should be. And this is properly noticed, and it should be. So I don't see any issues of that nature, but they're open for discussion. It's why it's on the public part of the agenda. And again, if anyone wants it to have that discussion and that vote take place earlier rather than later on the agenda, I would certainly entertain a motion.
I'm not sure there's the support on this.
Okay. Well, and let's do that. So
Well, I'm
we'll-
second the motion.
I don't think we have a motion. We have a,
I'm fine.
Okay.
you guys need more coffee in the morning. It'll be fine. It's gonna be good. I'm ready for coffee.
Let's go.
All right, so approval, then I need a motion to approve the agenda as is. So moved. Second, all those in favor say aye.
Aye.
Any opposed? Any abstain? I would like for the record, that Senator Rawson has indicated that we ought to have our action items, including any litigation matters, at the front of the agenda. I don't think that that's an issue, so we will make that a matter of course with you, unless anyone has an objection to that. Seeing none, we'll just do that by acclamation. All right, so then next we have approval of the State Investment Council minutes from April 23rd, 2019. Do I have a motion to approve the minutes?
I'll second, Madam Chair, but I think I have a correction.
All right, so we, State Treasurer, I'd like you to.
And thank you.
Yeah.
It's just the time that I left, I thought I stayed for the next vote as well. When we terminated the partnership with Sensors and then snuck out. Would you look at the tape again? And
I will, sometimes that's hard for me to do the clock and the, where I am on the tape, but I will certainly check and then make the correction, Treasurer.
All right, any other discussion about the minutes? And thank you, Mr. Treasurer, for taking a very close look. It is important to make sure that we're identifying who's here for all discussion and action items, so I appreciate that. Any other discussion or potential changes, amendments, corrections? All right, seeing none, all those in favor with the correction, if in fact we can identify that, but sounds to me like the members know when they're here. So I would make that correction. All those in favor? Aye. Any opposed? Anyone abstaining? Seeing none, the minutes from April 23rd, 2019, with the correction for timing of attendance by the treasurer included, are approved. All right, we are on item number 2, which is briefings from our state investment officer and chief investment officer, so Steve Moise and Vince. You're on item 2A.
Thank you, Governor. Good morning, all.
Morning.
As we report each month, total distributions to the state in May, $962.448 million. West Texas Intermediate Oil, most recent pricing at $58.95 per barrel. And our net asset value as of today, $24.568 billion. I would point out 3 things to you that I think are important that we'll be discussing or moving into within the next month. As has been mentioned already in the meeting, we are this morning bringing a proposed settlement in the pay-to-play litigation. And I do recommend this to the council, as stated in the memo. We will be having a working group meeting on June 6th to discuss New Mexico investments from the Severance Tax Fund. That day, we will have briefings by staff, by our consultants Mercer, Sun Mountain, and RBK. And the agenda for that meeting will be sent out to all of you no later than May 30th. So you'll have a week or so to review some in-depth briefing materials that I hope each member of that working group will have a chance to review before the meeting. That would make it a lot easier for us as we discuss those things. We'll be bringing you in July a document which is an operational annual plan as opposed to the investment annual plan, giving you some retrospective and prospective views on what you have done over the last 12 months. We'll be doing this on a fiscal year basis this year, as opposed to the way it was done last year, and it'll be in a different and more consolidated format. Taking a look at B on the report, I would draw your attention to the multi-year growth in distributions from FY10's $712 million to FY20's FY20's $1 billion plus. And those increased distributions were enabled or were facilitated by a growth in our net asset value over that same time period, as you'll see in B2, of $10.25 billion. So I think that's important for those listening on the web and for others to understand that as our net asset values grow, as I emphasize every chance I get, so do the distributions from the funds. Vince will be talking about performance. We'll skip over B3. I would like you to take a quick look at the investment holdings report. When you get a chance, you'll see that the monthly contribution from the state land office, thank you, Commissioner, of $71.2 million is an increase of $9 million from March. Year-to-year comparisons, April 2018 contribution from the state land office was $59.3 million, as opposed to that $71.2 million this month. The tobacco fund received $34.7 million in tobacco settlement proceeds, and that is also noted in your IHR. Please remember that we have no meetings in July. Neither the SIC nor committees will be meeting that month. Under D, operations, we are looking for, and I think have a good chance of hiring 2 investment strategists. We've heard from one that we know is very interested in the position. We're hoping the second one is. Vince has had good response, excellent response to these postings. Charlie is beginning his search for a communications analyst, and we will soon be looking for a New Mexico private equity analyst. Charlie and Carrie have been working on website enhancements, and I think you've seen a few of them, and you'll be seeing more. And if you want to know more about that, Charlie can comment on that if you have questions. We'll be speaking to the Petroleum Club here in Santa Fe on Thursday of this week. We have an excellent turnout for that meeting. And Carrie will be handing out to each of you, if you haven't already, Carrie, the supplement to our 60th anniversary report, bringing that current, showing our new council members, and a few updated facts. Madam Chair, that's my report.
Where's your Petroleum Club?
At Los Angeles, at noon on Thursday.
All right, do we have any questions or statements? Yes,
Just
Senator?
curious as to why the change of date in September from the Tuesday to preceding Thursday.
It's because of the,
Very-
Mountain States.
Yeah.
Institutional forum that's happening in Santa Fe that day, so we're meeting a week.
We have people coming in. The region for a conference in Santa Fe that staff has been asked to attend and participate in, and that's the reason for the change. If you have an objection to it, we'll be happy to change it back.
As long as it works for everybody out, it's a little bit complicated for me, but I'll make that work. I just trying to figure out what's right. If everybody's on board, then I'll make it work.
All right, thank you, Senator. Linda?
That's a real feather in our cap for them to be coming back a second year. The attendance was up a huge amount when they came to Santa Fe last year, and they decided to come back again, even though there are other destinations that they've gone to previously. So it's a real, it's wonderful for it to be here, and we definitely need a presence here. I would also recommend that any council member consider attending, because I think it would be beneficial for all of us too.
Okay, thank you very much. And anybody else? Any comments or questions? Yes, Mr. Treasurer?
I won't be able to attend, but that's why there's a little bit. I just haven't made a commitment on Thursday.
So,
This is the investment.
Wait,
yeah, this is the,
Confusion. This is the investment,
Oh, I'm sorry.
so,
not the council.
Oh, it's not the council.
Not the council.
No, this is the council investment committee.
I misread it then. I'm sorry. That's why I couldn't figure out.
Yeah,
I apologize.
I'm surprised.
not a problem. Are we all, see, I'm telling you, we need coffee. We might have to make it a mandatory aspect of the initiation of every single meeting. So that's the investment committee meeting. We now know when Mountain State's meeting is. Everything else is as it should be. And are there any other statements or questions or, okay. Seeing none, we will continue with item, yes. I'm looking, says, yes, yeah.
Should we start talking?
Start talking, you're on. Yes, you are. I'm to everyone.
I try to speak as low as I can because I managed to pick up a cold over the weekend. But first thing I wanted to note was Steve mentioned the interest in the investment strategist position here. We do get good interest across investment positions when we advertise them here. In this case, it was great interest. And I'll tell you why. I've asked these folks, and a lot of it has to do, or a good piece of it has to do, with the very good reputation of this council and the investment program that you have. So people say the New Mexico State Investment Council when they put it for the job. That's been the case with a lot of the strategist candidates I've been talking to. So
How many applicants did you have?
I think it was a little over 100. I haven't seen them all, but still, I believe there was a little over 100 applications for two spots. So a lot of it's due to the reputation that you all have in the marketplace in terms of investment professionals. So thanks for that kind of help, helping build staff. So we're gonna go over first quarter performance reports here pretty soon. I don't have the real estate and real return packet in there for you. It just wasn't ready. It's that time of year when they're doing full audits of valuations and things for these private assets. That takes a little bit longer. So your first quarter report, which would be your December numbers, typically takes a little bit longer. So nothing out of the ordinary there, but it's not the fact that this time we'll bring it to you in June. The asset allocation studies for tobacco and water are in there. We did these just a little bit different than we have in the past, and when we get there, I'll sort of give an overview. Matthias and Marcia are going to do the heavy lifting on those, but we presented more of an option sort of set up for the investment committee. We had a real good discussion around it by doing that, and we'll describe it to you. We'll hear a little bit later. The last thing I want to touch on before we turn over to Marcia and Matthias for your investment performance is I just got back from a week on the road attending two wellness conference, well, both were conferences that are heavily attended by other CIOs. So I had great opportunity, more than 60 CIOs, folks to actually sit in the seat. We're at these conferences. I had great opportunity I probably had 30 different conversations and a dozen or more in depth. Let me list for you the things that are on people's minds right now. And these are guys that sit at large public pension plans, other endowments, or other sovereign wealth funds and endowments, and some family offices. So a good mix of chief investment officers at these two conferences. Number one on everyone's mind is the length of the current economic expansion. Everyone's nervous about how long this has gone. It's been the longest in our country's history. We're at 120 months now. The previous longest expansion was 119 months. I guess we're 3 days short of 120 months. So at the end of May will be 120 months. The expansion started in June of 2009. It's been the longest on record. It's been fueled a lot by easy monetary policy, I should say almost extreme monetary policy with 3 QEs and huge increases in the Fed's balance sheet. This has been on a global basis too, not just our Fed. So we got about $500 billion on the Fed's balance sheet, which took it to $4.5 trillion in this last 10-year expansion. That's had a lot to do with what's happened in the financial markets and the economy in general. Even though it's been long, and even though we've had a lot of monetary stimulus to it, it's been low. This has also been one of the lowest growth on record that we've had, total GDP growth over the last 10 years. So even though it's been long, it's still one of the lowest growth expansions that we've had. We've marked that all the way back to 1919. So we're trying to go back a little bit farther to see if it hasn't been the lowest growth economy. Also, very low inflation this time relative to other expansions. That's been a little bit of a surprise to just about everybody. So here we sit, sort of late cycle. We talked a lot about that with you. In fact, it was a year ago now, May. We first started talking about it in March and April, and brought you a report in May about moving into late cycle. And at that time, we started talking about, okay, if we're in late cycle, when's the recession going to come? We marked it even back then, March or April of 2018 as mid-2020. That's still our base case. We haven't come off of that in the last 18 months. But there's folks out there talking now that this thing can keep going. That we could see another 2 years of expansion. It might not be much, but we would avoid recession. So we'll see. A lot of diversity of opinions. Some folks think it's right around the corner. Others are saying maybe this thing could go another 2 years. So there's a lot of uncertainty, and I think that's probably why the length of the current expansion is number one on everyone's minds, and what should we be doing in a situation like this. Second, very much was valuations. The U.S. stock market was the most frequently referenced as terms of overvalue, but also private equity. People are concerned about the valuations that their private equity managers are paying for assets that are coming into those portfolios. Third probably is the corporate credit market. That thing is huge now. It's expanded. In fact, it's 4 times bigger than it was in 2007 before we went into the last recession. The triple B portion of the market is almost as big as the whole corporate market was back in 2007. This thing is just growing like crazy. We talked a little bit about that. Very low interest rates has encouraged corporate CFOs to go borrow cheap money bring it on the balance sheet, go buy back their stock with it, which is expensive money in terms of capital for corporations. That's been a sort of a self-reinforcing loop here in the economy, and it's just blown the corporate credit market out to the size we just haven't seen before. So folks are worried about the valuations and more to the point of corporate credit to the size. Third is liquidity. Most funds have moved money from the public credit markets to the private markets, and they're recognizing, the implications of that as they've done it in terms of the assets being illiquid. I think the pensions are probably most at risk with this. We saw in the last cycle, a few funds, once the stock market had sold off, just simply ran out of cash, couldn't make their pension payments, actually had to sell stocks to the bottom. That very well could happen again. A lot of public pensions have moved that way to more private assets. I think almost everyone realizes that some funds got burned in that last cycle, and there's more plans in place for liquidity. And we brought you all a liquidity plan here almost 2 years ago now. We started talking about liquidity and brought you all a plan on that. So I think we're set. At least we don't have a pension obligation to be concerned about, just a standard distribution. But the concern about liquidity is straight across the board, not only the pension CIOs, but also the one other sovereign wealth person I talked to, and several endowment CIOs were concerned about their liquidity position right now, ahead of a potential recession. Last, you obviously recognize this, geopolitics, trade in China, Iran, the rise of populism. In fact, we just saw the weekend in France, further populism in France. So folks are concerned about that. And then more generally, global income inequality and ESG related items at these funds are becoming a little bit more important. So that's a very quick rundown on what guys that sit in my seat are thinking today. And certainly can answer any questions about that, or we can move to performance.
Vince, this morning in your Wall Street Journal was an article about municipal bonds and the fact that the investments in municipal bonds have just skyrocketed in the most riskiest of the offerings. What is there any history that parallels what that, in other words, that gives us any help looking towards the future?
I don't think so, Harold. A lot of the reason that there's increased risk in that market now, and particularly lower quality issues, is pension related. So these municipalities are having to pump more money into the pension fund. The funding is still expanding, and that's a big cause. And that's not happening. I mean, we've gone through periods of less funding, but we're probably as low funded as we ever been in the public pension space.
Any other questions, comments, concerns for Vince? Yes,
Just on the same
concerns?
issues, the state, we have very significant issues in areas of pensions as well. I spent I don't want to say ERB and ERA, but they still have to be addressed.
We're going to be talking to the commission that the governor set up on June 6th for a little bit on maybe forward-looking earnings and how much Para thinks they can earn.
Thank you.
For a little bit. We'll be addressing that a little bit.
Right, I might just point out, and I appreciate that, Vince, right, we set up a commission, we're clear that is a serious issue for the state, that liability has to be addressed, and there needs to be short and long-term strategies that get us where we ought to be, which is with the, not shorting the pensions. And it means I am clear that there will be sacrifices for employers and employees and figuring out current retirees and future retirees. But we are getting briefings by all related entities and making sure that the recommendations that come out of that commission are productive. And that is underway. So if there are members who are interested, in attending and getting a sense about what's being discussed, we'll make sure that you have information about that. They're all, yeah. Okay, you are, right.
Yeah, okay. I don't know about this.
Well, the work groups are working, and then there's two, I think, at least scheduled sort of larger public meetings, so I'll make sure that you have.
Thank you, Governor. Let me turn it over to Marcia and Matthias, and they're going to walk you through performance, and then I'll be back just for a little bit on before the asset allocation.
That's fine, Vince. I'm just going to make sure. Peter, did I see your hand up?
No.
All right. I'm having a little trouble. Try to go through the chair so I can keep track of everybody's conversations. That'll be helpful as we figure out who is saying what, so we get the minutes accurately reflecting the meeting. So that would be helpful. Sorry about that, Peter, I thought I saw your hand. All right, RPK.
So let's go to page 18 of your packet. This is the executive summary for the first quarter of 2019. So we're stepping back a few months. It's on page,
Which page?
33 and 34.
no, page 18, I just, page 18. So page 18, and we look at performance every month, so I'm not going to go over capital markets, but just to remind you, since May has been an interesting month, that we are stepping back to March, and if you look at the bottom left-hand, that table, and look at market performance for the quarter, the first 3 months of 2019, just remind you how strong it was. We were coming out of a horrible end to 2018 with any kind of risk asset, and we had a very large rebound on risk assets in the first quarter of 2019, mostly fueled, as we talked about the Fed standing down and agreeing not to raise rates. So the market rebounded strongly. You can see those in the numbers. The S&P was up over 13.5%. The Russell 2000 was up over 14%, and non-US equities were up in excess of 9, close to 10%, just for the first quarter. So we've talked about that, but just wanted to remind you since we're stepping back. I know Harold loves page 19, looking at the quilt chart and by year, what was the top performer, what was the worst performer. And as of the end of the quarter, REITs were at the top, and core real estate, cash was at the bottom, albeit everything was positive. Page 21 looks at your allocation versus your interim target and your long-term target as of the end of March. Vince goes through this each month in quite some detail. Again, the biggest, where you see the nose, says where you're out of range against your interim target. And this is a function of just transitioning, for the most part, from your core fixed income to non-core assets, moving from core fixed income to non-core fixed income. The real return, you're out of range slightly, but nothing dramatic there. We're going to skip a couple pages and go to page 25 and just look at performance against the benchmark. And at the top, we're showing what is stated in your investment policy, what your expectations are for the land grant and the severance tax. And that is to outperform the index on gross fees basis for the 3-year period. And you can see that you met that investment policy expectation. The table down below shows by quarter and then focusing on the long term. I do want to point out for the quarter, though, again, just reminding you that a 6.3% return just for the first quarter of 2019 is pretty dramatic. You underperformed your benchmark slightly there, but on an absolute basis, that was a stunning return. But again, focusing which your policy does on the 3-year, you can see the gross and net fees return for both the land grant and severance, and both on a gross and net fees basis keep the benchmarks very nicely. And you can see that carried out through the 3, 5, and 7 years as well, outperforming or in line with your policy benchmarks. Attribution is
Just a minute, I'm sorry, I interrupted you, we got a question. Thank you, Linda.
I just want to point out that 85 basis points outperformance is big.
Thank you.
Yeah.
Anybody else?
And it's big on the net fees as well, so that was well done. Attribution, we also look at this on a frequent basis, but again, we talk about it all the time. Most of your return, the abundance of your return comes from how you allocate the assets, not from the managers that you hire. And the attribution on page 26, which is for the land grant, reflects that if you look at the investment pool performance was at 6.31, 6.52 came actually from your strategic asset allocation. And you had some slight headwinds where you weren't for the yellow, which is where you weren't exactly at that interim policy target. And then also some style, headwind on style by 10 basis points slightly. You also had, though, you had positive on the whole for manager contribution was at 0.08%. Most of that coming from private equity and also from international equity and core fixed income for that quarter. That's again just for the quarter ended March 31st, 2019. So again, true to form, most of your return coming from how you allocate the assets. The same information is shown for severance on page 27, very, very similar. And then page 28, just to show by the total on the top, you began the year with 23.2 billion. At the end of the quarter, you were 24.6. Mr. Moise gave you the updated market value, and then you can see the underlying funds as well.
All right, thank you, Marcia. Any questions from council members? Comments?
I do have just
We'll keep going.
Just a little bit more.
You got it.
page 30, we always talk about peers. It's not an objective for you, but I think you're forced to talk about your peers because you do have peers, pension plan peers, I guess, in the state. So this is looking at how the land grant on page 30 compared to the peers for this period. And we show you three different peer groups. The first grouping is all public plans greater than 10 billion. Then we show you against all public plans in the universe, and then all public plans greater than $1 billion. And just a couple reminders here. This is a gross of fees universe. We're working very hard to move to a net of fees universe, but this still is a gross of fees universe. And just also to remind you that the way you report performance, like many others do, is it's a combination of both gross and net. So when we're ranking against peers, some of your peers just report everything gross. So that is a bit of a headwind for you too, because you have some numbers that are net of fees. So we're anxious to move to the net of fees universe where we're hoping everything is more on a level playing field and more apples to apples. But to look at this for the, just also stepping back, the fourth quarter of 2018, you ranked in the top third against your peers. Your allocation protected you on the downside, so you ranked well against your peers. The first quarter of 2019 was a run up in the equity markets, especially domestic, but also non-US. You have a lower allocation to equities in your portfolio that has protected you on the downside. That pushed your peer ranks down for the first quarter because you didn't have as much equity as many of your peers. Now, it's interesting to look at this peer information. I say it's interesting, it's not an objective. But if you look at, let's look at the all public plans. So this is tiny little public plans to very large public plans. There's 439 plans in there ranging, again, from tiny to large. For the quarter, you ranked 91st. Well, many of those smaller plans don't have a downside protection built into the portfolio that you did. So for the quarter, they did great because they had high equity allocations. They didn't look so great last quarter. So that's a difference in these universes. But probably the best universe for you is that if we look at the median and the average size, this falls in that greater than 1 billion. For the quarter, you ranked 84th. But let's look at longer term because you are a long-term fund. You can see you ranked for the 3-year 41st percentile, 5-year 46th percentile, 7-year 40th percentile on out. So you can see right around that median, slightly above median performance this against your peers. And if you look at the longer term against that broad, all public plans right above that, you can see how your longer term ranks are in the top quartile, top third, because of your allocation decisions. Any questions about that?
Anybody? All right, thank you for asking.
So page 31, I think is, we spend time on this, you've heard us talk about how you want to have a rank, you want to perform median, slightly above median, you don't want to be first percentile, bottom percentile, which is where you were. And this is a chart looking at 3-year rolling ranks over the time period back to June of 1995, where you were top, bottom, but look at the consistency over, Vince, what was it, we figured there was 23 dots that were really with the change in the change in staff. And if you look at those last 23 dots, they're where you want to be, right, slightly above median. If we look at that, 65% of them ranged in that 25 to 50, so above median. There's a small number that are below median. There's some that are in the top quartile, but you're falling in a very safe place to fall, and that consistency over time will serve you well. So I think this is a very important page in this executive summary.
Just one comment if I could, Marcia. Marcia Matias recast this for me in net of fee space. This is gross of fee space. They recast this for me in net of fee space. And I don't want to steal their thunder for next time because they're
Thank
going to
you.
this next time. But it's shocking. I thought they made it out.
Well, and it just, again, we're not ready for prime time with the net of fees, but each point was median or above.
Could we see them side by side when you present? I'm sorry.
Yeah. Yes, thank you very much. And Commissioner, go ahead, Stephanie.
When you present the net fees, can you see them side by side?
Yes.
Yeah.
Good idea. Anybody else? Thank you.
We have the same information for severance on pages 32 and 33. Page 34, I think is also an important page to take a look at. This is looking at 2 different universes for 2 different time periods. The top left is looking at that universe of plans with assets $1 billion and over. This is for the 5-year period. Right below it's for the 10-year period. If you look at the 10-year period right below, you can see the green is land grant, the blue circle is the severance, and then you can see where the policy indexes are. In both cases, the policy indexes have lower volatility than the actual composite. But what's interesting is you go up to the 5-year, which is a period where you have been diversifying or transitioning the portfolio. You can see you've moved your return up to that median level, and you still have below median volatility when you compare against your peers. And the same story is true if we look again. You look at yourself against the larger plan universe as well. So median returns taking less volatility, having less standard deviation or less risk in the portfolio. And you're moving in the correct direction. We want to see you in that northwest quadrant where you have above median returns at below median risk, and you're there. We just want you to move up a little bit more in time. You're moving in the right direction.
Thank you. Any questions, comments, concerns from council members? Yeah, Linda, I'm sorry, thank you. I need that help.
Just a comment on why that consistency is so important. It's sometimes easy to forget. If an asset goes down 50%, you have to have 100% return to get back to where you were. So therefore, the volatility really is very difficult to make up. When you are skipping up and down and up and down, that down, you really have to have a big up to even break even. So just as a performance reason, it's good to have consistency. But the other reason it's good to have consistency is our beneficiaries. They want to have a similar or larger amount of contribution from the distribution from the permanent funds each year. And if we saw that rolling average where you're up and down, they don't know where they're going to be. But again, if you remain consistent, then what's going out of the permanent fund stays more consistent too. And that is really our mission, is to fund education with a consistent stream. So that chart's really important, and to look at the consistency is very important.
Thank you. Anybody else? Thank you. Anything else?
Just a couple comments on asset classes. I'm just gonna take you to page 38, where we look at the US equity update. It shows where your targets, your target for US equity is 24%, your long-term target, or 20%, excuse me, your interim target's at 24% for land grant. This page also updates you on any manager changes. This didn't happen in the quarter, but we did put SIC in there because we made that change in April. And then we also put commentary of any existing managers where there were changes. Nothing that gives us heartburn or concern. There was a really kind of a succession planning change in AQR. I do want to point out on performance on page 39 that you have seen your US equity composite underperform the Russell 3000 index. That's been a hard benchmark for active managers to be really since post-financial crisis. So you will see underperformance on the gross and net fees, but look at the ranks. I'll point these out to you of the composite. So this is looking at your US equity composite to the US equity composite of your peers. You actually are median or above with your US equity performance. So this is just saying, not just for New Mexico, but for many funds, US equity composite has had a difficult time outperforming in this market environment. Page 40 looks at those risk returns. I think it's important also to look on page 40 on the top left-hand side to show where you fall in that northwest quadrant, where you have, for this 3-year period, you had above median return at below median volatility. And on the right-hand side, for the 3-year period, there have been 10 up quarters, only 2 down quarters. You captured most of the upside, but you were protected somewhat on the downside, and that's what Starla and Vince have told you, the portfolio they want to build to protect on the downside, so you don't have to make up so much if there is a drawdown. We also have similar information for non-US equity, really no manager changes there, page 42. Same information here, you're actually outperforming your benchmark, your ranks for the 3-year at 40th percentile, slightly below for other time periods for your non-US equity composite. And then we show the risk return here as well on page 44. Just quickly. And then on the fixed income side, wanted to point out on page 46, any changes there, and then any differences in your target versus your interim versus your long-term. In here, it's a matter of moving part of the allocation from the core to the non-core, and you're in the process of doing that. We have both a core fixed, on page 47, a core fixed income composite and a non-core. Your core composite is met its policy expectations. The non-core has not, that non-core has not been, it's being transitioned in.
Peter, thank you for going through the chart.
I'm not really being super critical, but I would just comment that when I read through this and I see the little box that says explanation, the explanation tends to be a mathematical repeat of what the data says, as opposed to an explanation. Either let's just get rid of it or put in something substantive. Either way is fine with me.
We'll change that.
Perfect. Anybody else? Okay, thank you, Peter. Thank you, Marcy.
And then on the rest of the asset classes are your alternative asset classes. Your managers will be coming in and giving you updated performance for those, so I wasn't planning on going through those alternative asset classes.
All right. Anything else from RBK? Yes, no? Okay. Any questions, comments, concerns from council members? Yes, Linda?
I'm gonna climb into the investment part. The quarterly reports are really the thing that we should be concentrating on. Times when we get monthly reports, we kind of miss the forest for the trees, because the monthlies gives all the data that we might ever want, but it's the quarterlies that focuses in on what was our target, what was our policy, how we meeting them, why we aren't, how we're doing it versus our peers. So I think these quarterlies are really important, and I think the monthlies are nice to have, but these are the ones that we're spending our time over and looking to see if we're doing our job.
Thank you. Yes, Marcia?
You probably read it, but haven't read it recently, but there was a push probably about a month ago, really a lot of discussion over why are we looking at short-term performance? Why are we looking at performance every month? Why are we even looking at quarterly? Why are we looking at monthly? Why are we looking at 1 year? Where these are long-term funds, performance reports should be flipped, where you look at long-term numbers and focus on those and have the shorter-term numbers right. So to that very comment, the monthlies are good information, but they're monthly, and certainly we can see these days how it can change month by month.
Okay, thank you. Anything else? All right, thank you very much for your reports. Thank you, council members, for your comments. We are still on agenda item 2. I believe we're now on 2B. Is that correct? Yes, sir, come on up. So we've got Lee and Mercer to talk to us about Q4 2018 investment performance reports. Good morning, gentlemen.
Good morning, David Reed, Private Equity Director. I'm here with Richard Pudmeyer of Mercer, formerly known as Pavilion. What are we going over, just as a reminder, the private equity performance and all the liquid asset classes performance are 1 quarter lag. So this is the 4th quarter of 2018. And the performance report starts on page 82 of diligence. I think Richard is going to start on page 85.
Well, everybody's turning there, just, we're a little bit more lag with Q4 reports because the private equity funds actually get audited in the 4th quarter. And so instead of receiving reports, the typical 45 to 60 days after quarter end, it's more like 90 to 120 days. And so that's why we're here at the end of May talking about the end of December performance. If you'll recall too, in Q4, it was a very volatile time in the public markets. Public equities were down quite a bit, rates were going up. And so it was with a lot of interest that we were looking at the reports coming in and seeing how they were tracking. And what ended up happening was the net asset value did decrease by approximately $21 billion. That's compared to over $100 million increases in Q1, Q2 of 2018, and about a $70 million increase in Q3. So overall, 2018 was still a strong year of net asset value gains, but the decline wasn't necessarily driven by performance. We did have a larger amount of losses, which I'll talk about, but it was that we had more distributions coming out of the portfolio. So more of the investments were liquidated and sending cash back to the State Investment Council, which drove that, which I'll talk about on the next slide. If you look at the chart on the bottom, that shows the rolling 10-year return. And one of the things we've done there, because there's not yet 10 years of history for the 2011 and after vintage year funds, we show what's that 10-year return of the 2009 and before, and then what's the total return, so you can get a sense of how the fund commitments since the restart of the program in 2011 are impacting the performance of the program. And you can see they're having a positive impact with increasing from a 9.6% 10-year IRR to 11.1%. That's driven by since inception for the 2011 and after of about a 15% net IRR. There's no questions. I'll turn to the next page, which shows the quarter-over-quarter performance. We did have more funds reporting losses than gains, which wasn't surprising given the volatility we had in the quarter. Although, if you look at the chart down below, we did actually, when you aggregate it all together, have a small gain in the portfolio of 1.8 million. But really what drove the net asset value decline was we had 105 million of net distributions compared to 82 million of distributions coming into the portfolio. To give you a sense of how that's tracked post December 31st, we actually, contributions are exceeding distributions by about 60 million so far year to date. Distributions have slowed down a little bit. We've only received about 104 million distributions through the first 5 months of the year, which is about the same amount that we received in Q4. The next page, on page 6 of the report, some of you may be wondering, well, what's some of the volatility in the market in Q4? How did we have so much distributions? Well, what tends to happen with private equity is it takes a couple quarters for a deal to get announced and then closed. And so what we saw is, if you look at the top quarterly distributions on the lower left box, the Vista distributions, for example, that deal was announced in Q3 and then actually closed in Q4. So what we could be seeing now with the lower distributions is an impact of that volatility in Q4 where distribution activity is not as active right now. Although talking to the portfolio managers, as Vince mentioned, with valuations high, a lot of them are trying to sell portfolio companies, are in processes. So we might actually, depending on market conditions, see an increase in distributions here later in the year. So it's something to watch for. What I talked about too with the losses, we actually had 10 funds that reported losses greater than 2 million. For comparison, Q3 had 4 funds that reported losses greater than 2 million. And what drove a lot of the losses was mark-to-markets. So some of these funds hold publicly traded stock. They have to mark-to-market to the stock price as of the end of the year. There's also those last two funds there have a lot of debt positions. And with rates going up, that caused the debt prices to go down, and so they had to mark-to-market as well. But we did have a number of gains that outpaced the losses, mainly coming from improved operating performance or a sale of a portfolio company at a higher valuation. The next slide is performance by vintage year, which shows the benchmarking. One of the interesting things, we do have benchmarks as of December 31st, so this isn't a delay on the benchmarks. When looking at the benchmark values, what's interesting is most of the benchmark values either stayed the same or were slightly higher, kind of the experience you had in your portfolio. We did, looking at the 2011 and after, we did slip below median on an IRR basis in 2013, and then also on the 2015 funds. 2 of the top 5 losses were 2015 vintage year funds, and so that's what drove the slip down below median. The other thing I like to highlight too on the slide is you look at the remaining value column. There's still a lot of remaining value in the 2009 and before vintage years. We want to see more distributions from those vintage years, especially with where we are in the market. This is you figure most of these funds were invested, fully invested more than 7 years ago. We want to see more distributions from these funds. The next slide shows the public market equivalent. We actually dropped off of that. This is a rolling 10-year. We actually dropped off one of the worst quarters, which was Q4 of 2008, in creating this 10-year. And so the 10-year IRR actually increased from 9.6% to 11.1%, but so did all the other returns increase as well. And so it ended up not being any significant changes in the difference between the private equity portfolio and the public markets. And public markets have just had a really strong performance, and so they've been outperforming the private equity portfolio on a 10-year basis. And then the slide I'll end with the national program is slide 9, which is our strategy targets. We have an annual commitment range of 550 million to 650 million. We're going to revisit that in the annual plan that's coming up and looking at different things in the portfolio and seeing if that 550 to 650 is still valid given kind of the current assumptions. We have made 3 commitments so far this year for up to 275 million, although I think we will officially get cut back on at least one of those that's oversubscribed. As far as strategy goes, we are all in compliance. One thing I do want to point out is the venture capital, the 0 to 5%. One of the reasons why we have that so low in the national program is because of the state program, which is heavily focused on venture capital. So we don't want to get you too overexposed from an overall portfolio perspective on venture capital, which we'll talk about in the next report. Geography is all within targets. We have concentration guidelines, which is kind of long-term where we want to see the portfolio. We do have one manager that's greater than 10%. They've been added to the portfolio. They've generated a 14% net IRR for you. But as you make new commitments, that number has been coming down. Then there's 5 fund series that are greater than 5%. All but one of those fund series is actually generating above a 15% net IRR, so also additive to the portfolio returns. And then looking at managers and funds, this is also a longer term goal we have, where we want to end up having less than 30 core managers and approximately 75 to 100 funds to make it more manageable for staff and for you in monitoring the portfolio. It has taken a long time to liquidate those older funds. We ended up having 5 liquidated in 2018, which I think was the largest year since I've worked with the portfolio in 2011. So we are starting to see it happen. But since 2011, we have stayed disciplined on focusing on that core group of managers. We've made commitments to 24 since 2011. And so once we can kind of get that older portfolio liquidated, you'll see we should be within this range. And then we have some more details on each of these areas on the slides following. But I'm happy to answer any questions that you may have.
We'll take Linda first.
Can you comment on Vince's comment regarding the SIO's observation that private equity is getting, targets are getting pretty expensive and
Yes.
what effect that might have?
Yeah, there's been an increase of capital within private equity. And so just like any asset class, an increase of capital, more people looking for deals is going to cause valuations to increase. And so that's something that you see in the market statistics. What we try to bring you in front of the and that's where you've got to be cautious in making new commitments, because if you're blindly making new commitments at this stage, and managers don't have experience across multiple economic cycles, they could make mistakes and buy something that's too expensive and then end up not being able to sell it at a gain down the road. We focus on managers that really have a value add component. So they might buy something expensive, but then they do add-on acquisitions at lower valuations to lower the cost. They'll do operational improvements to increase efficiency and increase earnings to grow into that valuation and actually end up being a gain. And then the other thing I think you've seen us do over the last few years is we're being a lot more cautious. We were below our target on commitments last year, and part of that is just looking at quality. We really want to focus on quality managers. We're not going to put the capital out just to put it out at this stage of the cycle.
And there's usually two different ways that people can respond to higher valuations for these companies, which by the way also includes the public equity markets in terms of their highest valuations. One, they can start increasing leverage a little bit to try to make up that difference when you keep that same target. So taking on a little bit more debt to get more bang for the buck or your equity, that creates a situation where it may be a little more dangerous. So we do, as part of our underwriting, part of our conversations, monitoring the portfolios, we do make sure we query the managers on that. And then the other thing that they do, as Richard mentioned, is to try to make part of the add-on acquisitions a larger part of their strategy. Typically, those are smaller companies that they're, by definition, adding on to certain product lines or certain geographical areas. And because of more of their limited focus, there'll be a lower multiple. And therefore, when you blend that multiple, it'll blend it in.
I just wanted to follow up on Richard's comment about the strategic range on venture capital being low because of concentration and exposure in, I guess what we're now calling the regional program, the Mexico program is so high. One if we combine them as an asset category, where are we overall in venture capital? Or ask it a different way, what would you be recommending our total exposure to venture capital would be if you didn't have to back into it because the venture capital concentration in New Mexico is so high?
Yeah, so the net asset value of the regional program is about 400 million. Make sure I got that right, yeah, 400 million. And so that's the equivalent of the size of your growth equity portfolio right now. So about 18% of, so if you were to add it, it'd be a little bit lower because you're adding it, but probably around 15% of the overall portfolio will be venture capital. We usually have a wide range on venture capital because the returns are have a much wider dispersion in venture capital, and manager selection matters a lot more in venture capital. And one of the things, we have looked at venture capital managers for years past. One of the challenges is kind of the public nature of the council, coming to this meeting and presenting, just kind of challenges around that, because a lot of the good managers don't need to raise capital from public institutions. So usually we do have kind of a wide range. So we previously had 0 to 10% in there, and it really just kind of depends on risk tolerance and liquidity. Hold periods tend to be longer for venture capital, but typically what we see is it depends if you group growth in there. We kind of separated growth in your portfolio, but kind of 10 to 20% venture for a portfolio like this.
Other questions? Do you have any comments on the RISE funds?
Well, yeah, you're referring to the varsity blues?
Well, yes, of course, yes.
So, you may have seen in the news that the manager of the RISE fund, Bill McGlashan, was involved in the varsity blues scandal, where this was where parents kind of pay colleges to get their students into the universities. TBG took swift action and removed him, did an internal investigation, and didn't find any other wrongdoing that he'd done in the portfolio. They also kind of put in place Jim Coulter as kind of the interim leader of the strategy. They were raising RISE 2 at the time. They actually gave limited partners an option to back out of their commitments if they had already committed to it. And they're now looking for kind of what to do kind of for the next generation. In our view, TBG's kind of acted well for what they've been kind of faced with this unexpected. And so we continue to monitor the situation. You had staff at the advisory board meeting for TBG. We were there, and so we are monitoring that situation closely.
Okay, thank you. Any other? All right, so we now look at New Mexico.
Yeah, so we did a similar format with the New Mexico State program, except on the dashboard. One of the things you'll notice is we changed kind of the investment type rather than the strategy, because most of the portfolio is in venture capital. We did put in the appendix, if you're interested, to see the split by the sub-strategy. We did put that in there. But you could look at the New Mexico program as kind of having 3 different approaches over the years. One is fund commitments, which is similar to what the national program is, investing in fund managers. You also have the co-investment funds, where Sun Mountain Capital manages funds that will co-invest alongside other managers in New Mexico companies. And then you have the Catalyst Fund, which is a fund of funds focused on funding kind of seed stage, early stage New Mexico funds.
We're on diligence page
112.
So this has the since inception performance. You can see really the drivers of performance in the strategy. The Catalyst Fund is still too early. You can see the volatility there in the returns on the net multiple going from 1.5 to 1.01x. That's the classic J curve right there. The co-investment funds have been a big driver of performance with a 10% net IRR, 1.8 times net multiple as of December 31st. And then the fund investments as well have been about a break even. There's been some good fund investments that have been made, and there's been a lot of fund investments that are lost, kind of speaking to the volatility of venture capital returns. The graph at the bottom shows that rolling 10-year return. You can see that improvement over the last few years. The 10-year IR has gone up to 6.6%. One of the differences I'd say between the national program and the state program, though, is we haven't gotten the distributions in the state program like we have the national program. Part of that is the early stage nature of the portfolio. Hold periods tend to be longer. You got to find an exit opportunity, whereas companies are more mature in the national program. They have earnings, they have revenue. There tends to be more buyers for that. The next page shows the quarter-over-quarter performance. Contributions were quite a bit greater than distributions in the fourth quarter. I think what you'll see with this portfolio too going forward is the distributions will tend to be lumpy with the venture capital portfolio. There was a realization in Q3, so that's where you see the $5 million in one of the funds that was at a higher valuation. But as realizations come, you might see one quarter where distributions are a lot greater than contributions. Post December 31st, we haven't really seen any significant distributions yet. It's about 700,000. Contributions have been about 8 million. So money continues to go out. Page 6 shows the details. Contributions were a lot more as a lot of follow-on investments and new investments were done in the co-investment funds. Didn't really have any significant distributions, and you can see that there was kind of like a wide variety of gains and losses. And this is where venture capital companies tend to be a little bit less correlated than the market, although there is still some correlation with public markets than say buyout funds. Because if a portfolio company makes progress on developing a product, or they might sign a big client contract, that will impact the valuation more than whether the stock market was up 10% or not. So you do see a wide variety here. Looking at the vintage year, page 7, you do see kind of a natural break in the 2007 vintage year. 2007 was also the biggest year of commitments, where there was 2 co-investment funds that were funded and also some fund commitments. But the net multiples kind of 2007 and after are all above median. And before that, I mean, there really was mixed performance. There were some vintage years that were really bad. In fact, 2005, there was a small New Mexico fund where a commitment was made and the performance was just returned very little of the capital. But you can see a lot of the exposure is still in the 2007 vintage year too, where those co-investment funds remain valued. The PME, similar to the national program, although there's a bigger difference here. There is underperformance against the public markets, although over time, as there's realizations, especially if the realizations come above current valuations, you can see that number jump. We do tend to see that with some venture capital portfolios. And we don't have a strategy slide yet on the state program. We're hoping to develop that with feedback from the working group. And so just walking through real quick the status of the portfolio on page 9, you'll see that about half of the commitments were made to fund investments and co-investment funds, with the small sleeve to the Catalyst Fund. With the current valuations and the performance, like I talked about, the co-investment fund performance is really helping the overall portfolio. You do have most of the exposure in the co-investment funds, approximately 73% as of December 31st. Page 10 shows the diversification by vintage year. Again, 2007 was a very active year for the program, and since then, kind of 2014 to 2017 has been a mix of fund commitments and also co-investment re-ups in the form of tranches. And then diversity by geography and industry. I found this interesting on page 11. About 67% of the remaining value is in New Mexico-based companies. 30% are in in North America, not including New Mexico. So most of your portfolio is North America, not surprising given the type of managers that are invested in. And the two main industries are information technology and healthcare, which is also expected of a venture capital portfolio. Those are the two big industry focuses of venture capital. And then 12 and 13 show the top 5 exposures, both by the general partner relationship and then also the fund series. Really, the difference is Sun Mountain manages both the Catalyst Fund and the co-investment funds for you, so the GP exposure includes both of those, whereas the fund series just includes the co-investment funds that they manage for you. So this gives you a sense of the largest. Epic Ventures is also done well for you in Fund 4. They're the second largest exposure as of December 31st. And I'll end with slide 14, where normally part of this report will be the economic impact and talking about that. We reached out to all the managers to request this information on this chart, including some that came up at the Council Investment Committee, such as, did they take advantage of any state incentives that are offered by the government, or did they move out of New Mexico for some reason? So we can also track that information. We've been also reconciling the data that Sun Mountain gave us with the data that's in India as well, so that everything can kind of be traced back. There's an audit path to the different companies, so that if there is something looked at some point, we have everything kind of documented. I'd say too, we've met with every manager in the portfolio, including the current fund commitments. And I've got to say, personally, I've been very pleased with the activity that they're doing in New Mexico. Many of them have done New Mexico investments. All of them are looking at New Mexico and taking their commitment from you seriously and trying to find an investment in the state of New Mexico. And we have a very full pipeline of potential investment opportunities to look at too. And I expect later this year that we'll be bringing some to you.
All right, thank you. Do we have any questions? Yes, Senator Rosson.
Yeah, thank you. Richard, on your page 7 or 115 in ours, and you have the similar, that's on the state program, but on the national program, it's the same thing. Why don't you sum the totals of the other columns rather than just the New Mexico SIC? But you don't sum the tiers, or you don't, the sum's not the right word, but you don't calculate the average. I just wondered why you don't do that. Would that be instructive? Kind of know where those breaks are? Yeah,
I mean, with benchmarks, I mean, one of the weaknesses of benchmarks is, your exposure doesn't exactly match the benchmark's exposure. So for example, year 2000 and 99, 98, there's a lot of venture capital funds in the venture capital benchmark, whereas, most of your exposure comes in 2007. So the weighting of the benchmarks wouldn't exactly match the weighting of your portfolio, and so it would be really difficult to kind of compare a total SIC return to a total IRR multiple. But what we've done in the past with analysis is we can weight the different vintage years by your weightings and then calculate a weighted average using the benchmark returns.
It might be interesting for comparative reasons.
Yeah.
Thank you.
Thank you, Senator. Any other questions, comments? Did I see that hand go up? All right. Thank you very much for your reports. We appreciate it. All right, we are now on item 3, investment matters. So we've got a report from the investment committee. Linda Eitzen,
Okay. You have pretty much everything that we had at our meeting, so you are aware of what we looked at. If you read the minutes, you'll see that we do talk about other things that are brought up here, and you can be rest assured that we're looking at things very carefully. The two things that are action items coming from the investment committee are the asset allocation in the tobacco and the allocation in the water trust. And we did recommend potential number 2 for the tobacco and potential number 3 for the water. And we'll be coming to that as a full council directly.
All right, thank you. Linda, on item 3B, that allocation review. Yep, RBK and Mr. Yeah, okay.
If I could, Governor, so make just a couple of very general comments about this. So annually, RBK comes with us with new capital market assumptions for longer term periods. This time, as you'll see, it was good. Some of them were up. We'd like to see that. The past few years, we've priced numbers that are down. But this year, a little bit of change. Most of that, I'm sure, had to do with sell-off in the fourth quarter, but TS will get into that. Really, I want to focus on the two asset allocation approvals that we're asking for. Maybe because we did these a little bit different than we typically do. Typically, when we bring you, well, in the past, we've had big changes from our old allocation to the new allocations. But typically, when large funds like us have an asset allocation, it's more about efficiency. So you change the assumptions a little bit, and if you raise your weight in real estate, lower it in international equity or something, it creates a little more efficient portfolio. Sometimes we'll also bring changes that maybe eke out a little bit better return. But for the most part, it's an efficiency-based portfolios that we should also back from. These are a little bit different. We showed the investment committee 3 portfolios that had distinctly different risk profiles. And we did that for a couple of different reasons on these two. Number one, we felt like we could take more risk with the water fund, and we just walked you through that a little bit. Maybe because of the stable distribution that fund makes. We think we can try to earn a little bit more with that one. And we had a decision about the tobacco fund. Historically, that's been invested along the lines of land grant funds, so the growth type portfolio. But we just did an asset allocation for the tax participation reserve fund, the TSR, and took a much more conservative approach with that. A lot because of guidance from the legislature that they were concerned about liquidity, but also to make sure that money was available. So given that the tobacco fund and the TSR are similar in nature, tobacco fund's also a reserve fund. Now it's what we call last money out. So statutorily, it's the last of the reserves that the state can have. It's got a little more protection than the TSR did. But we really thought through, should we be managing the tobacco fund more like the TSR, given it's a reserve fund, or should we maintain the allocation toward like the land grant fund more growth mode? Ultimately, the committee sort of picked something in the middle. I think all 3 allocations, and we'll get there, all 3 allocations were very valid for that fund. This will earn a little bit more money for just a little bit more risk, and given that it's sort of last money out, I think it's justified to keep that kind of a profile or have that kind of profile. But I just want to front end that, front end Mathias' comments with those things.
Before you head on, Peter, would you like to be recognized? You're very welcome, sir.
We've never had a liquidity issue that the tobacco fund had.
We've not. The only time they've drawn, Peter, since we've been here, was back when oil was $25 a barrel, and the other drew half. So they won the other half. We had to sell stocks to do it. We had to sell some stocks to do it. We were fortunate though, the stock market was up at the time. If we kind of get a confluence of stocks down and oil down, and say budget down, it'd be a little different situation.
Okay. Thank you, Peter. All right. Anybody else? All right. Vince?
Great.
Proceed.
Well, we'll start behind page 142 of the materials, and as was already mentioned, this was reviewed extensively at the CIC level. All the materials are included in this packet, although for the sake of facilitating a more expedited discussion, we've created somewhat of an executive summary for your review to highlight the key points. Although if there's ever any interest on the part of any of the council members, I strongly encourage you to participate in those CIC discussions as part of the annual review of these topics, because we do review them on an annual basis. On page 143, just briefly, we'll talk about capital market assumptions, because there are new council members here that may not have heard this a number of times. So the capital markets assumption process is a massive undertaking by our firm, but really any firm that strives to develop their own set of capital market expectations. They're arguably one of the most important aspects in terms of what we do, because they help determine the strategic asset allocation and the modeling thereof. And as we've discussed and seen in the attribution and heard and talked about many times, 90+% of the return experience in any fund comes from exactly this. And these are essentially the building blocks. Our forward-looking expectations are exactly that, they're forward-looking and they're long-term in nature, so they're 10 to 20 years is the time horizon. They're not short-term economic assumptions or expectations, but rather what we expect the markets to do over a full or in some cases multiple market cycles. There's always three components that we try to estimate. The first is what will an asset class return. The second part is with what risk, so what's the volatility, and then what's the correlation or the interrelationship between that particular asset class with all the other asset classes. So how does it behave? And when we have those three pieces, we really have all the building blocks needed in order to develop the modeling that helps us review and then also ultimately decide on appropriate asset allocations. I think it's important to differentiate and make the distinction that these are all just passive expectations. So essentially what the index and the broad markets will do, we don't assume any outperformance by active management or anything else. So they're fairly conservative in their approach. And anything we get above that, so call it excess return by your active managers, in many ways is sort of icing on the cake, but is not baked into what we anticipate. And you should, because they are long-term in nature, you should expect gradual changes. We don't wildly swing our expectation from one year to the next because, well, A, you're a battleship, you're not a speedboat, so you couldn't move the portfolio that quickly anyway. But really what we're trying to do, as Vince mentioned, once you get to a point where you have a good allocation, it's more about refinements on the margin, not massive changes. And you have the flexibility within the portfolio to implement and take advantage of opportunities should there be a severe market dislocation through your liquidity, budgeting, and other aspects that would allow you to deploy and take advantage of those opportunities. So we do that more on an implementation perspective, not on the asset allocation perspective. On 144, and I'll go quick, just again, for those that haven't seen this or aren't familiar, the way we build these capital market assumptions for each asset class is really we break them down into the fundamentals. We say, what are the return drivers for a particular asset class? And some asset classes are similar, others are unique and distinct. But we try to break them down, identify what those various return sources are, and then estimate what we think based on what's been happening and looking back at history, what we think those will do. And then once we have an expectation for each of the underlying components, we roll that out. So on 144, you see that yield. So we take a look at the income, we look at what we think inflation will do, what's the growth potential for that particular asset class, and then how does valuation either benefit or potentially create some headwind for this asset class going forward. Just pause if there's any questions.
Any questions, comments, concerns from council members? Okay, proceed.
Okay, great. I think there is a temptation whenever you have any expectation to sort of check in and say, well, were you right? And I think that's always tempting, and in some form we do. But I think, as you'll see on page 145, what we truly care about is the relative accuracy of asset classes. So if we come to you and say equities are going to do better than fixed income, we hope that that is true, rather than us saying equities will return 7% and they in fact return 5 or 10. So we care about that ordinal rank, that relationship in terms of where an asset class ranks relative to others over the long term, more than what the actual return experience is, for different reasons. They're both important, but the first, when you get that relative relationship right, what you end up with is a portfolio that's well diversified. It's a portfolio that will perform as well as it can, regardless of what the capital market conditions are. So the markets might be great or they might be terrible, doesn't matter. This type of a portfolio will do well because you've got your mix correct. The absolute accuracy, though, and I don't intend to dismiss it, because it does have important implications. I just think it's a lot harder to get accurate, and B is sort of secondary to that in terms of priorities. Where it is important, though, is two areas. The first is what we think you can reasonably earn, so setting return targets. setting spending policy. So what is a sustainable spending policy in terms of what you're spending? Is it 5? Is it 4.5? Those types of things. And so if we're too high or too low, that could potentially misinform some of the guidance that's appropriate there, and that obviously flows into intergenerational equity. So we want to make sure we get as close as we can there. But it is two parts or two moving pieces that really we try to look at and get as accurate as possible. Is that, hopefully that's making sense. If there's any questions, I'd be happy to dive deeper.
Happy to look, it looks good. I don't think we have questions or comments.
Okay, on page 146, you'll see the actual capital market assumptions. And again, we do this for, I think at this point, we're up to 65 or 70 asset classes. The list grows, and to some degree, it's no longer asset allocation, it's really structure decisions. But there is sort of this thirst for diving deeper and deeper and deeper. But generally, I think what you have here into these broad asset class buckets makes sense. You'll see that we have, as particularly for the traditional assets, so U.S. equity, international equity, and core fixed income, we're using our standard assumption. So that's an assumption that we use across our entire client base. And then for the bottom 3 or 4 asset classes, where you have a more unique implementation that does not very closely resemble what the broad market does, either because you have more assets to deploy, you're more sophisticated, number of different reasons. We actually hone in on that particular asset class and say, we're going to construct our assumption specifically for you based on the way you've designed this particular asset class and what it is intended to do to get you a more accurate measurement. The asset classes are listed on the left-hand side in the column, and you'll see the nominal return, GEO. I know there's a lot of words. Ultimately, what it means is it's compound or your geometric return, the return you'll earn with volatility included, a number arguably you should look at. And as you go down that column, you'll see that they're not that high. In fact, there's not a single asset class that is at 7%, which is your return target. There are some that get pretty close, but none of them that really breach that. And that is because, again, we talked about it, and Linda mentioned it, that the dynamic of volatility, and when you have losses, it really erodes your long-term earning power from these asset classes. So you see that reflected in the geometric returns. Now, correlation and negative correlations or low correlations are a bit of a secret weapon here, in terms that you can have asset classes that that on a standalone basis return X, but by the time you combine them, because it reduces the overall portfolio volatility, actually have a better prospective return. So this is in part why we're doing what we're doing, and why you have some of these other non-correlated or lower correlated asset classes as part of this. To the degree that you're interested, on the very far right-hand column, so that third one to the right, you'll see the year-over-year adjustments that we've made. So 2018 versus 2019. Again, they're fairly gradual. You'll see that on the return basis, we've increased most of these asset classes by a small amount. The U.S. equity, even though we had a big decline in the fourth quarter, we didn't, because we saw right away that January recovered essentially all of that. So it would have been short-sighted of us to say, oh yeah, go into U.S. equity, just because it was sort of endpoint sensitive. So we knew that, and because of it, held it constant. The two asset classes that declined, and we already talked a little bit about private equity, the elevated valuation, the amount of dry powder, sort of rising interest rates and what that does to the financing costs. So there's some drivers that have, at least in our minds, diminished the return expectations a little bit, and we took 25 basis points off our return expectation. And then on the real estate side of things, same thing, cap rates are essentially at all-time lows, so valuation is still quite elevated. The spread to treasuries has come down, it's still positive, but all in all, as we look at this and the yields, we think that while still a very attractive asset class from both an income and correlation perspective, the total return earning capability of that asset class has come down. But I mean, all you have to do is look back and see that it's been property prices have been increasing double digits in a lot of places. That's not sustainable, so you have to bring some of that down. So that's the overall framework of the assumptions. 147 lists them from high to low.
Before you leave this page,
Yes, Vince?
let me make just one comment if I could. If you take a look, Matthias talked about the relative returns, the relative among all the asset classes. If you take a look at that far left column of numbers, you can see that 5 of the 7 asset classes that are not U.S. equity have a higher expected rate of return than U.S. equity. It's highly unusual. I've done these studies for 30 years, and that's very unusual to see the U.S. equity assumption be that low relative to the other asset classes. So we've really pulled down your U.S. equity exposure over the past few years. It was 47%. I think we came in, you're targeting 20 today. I think you're about 19, as you said. You can see that in the reports coming up here. So very much taken a lot of money out of U.S. equity and put it in these other asset classes that have higher long-term rates of return. So, but I just want to point out, because that is so unusual to see that U.S. equity number so low relative to the rest of the options that you have.
Thank you. Yes, we've got a question, Linda.
We also talked at the CIC about adding a couple of other columns, and that would be the SBIC, because that is now going to be at 2% of our severance tax, and the New Mexico private equity is currently about 6%. So that's 8% of the severance is already in investments that aren't in our food groups here. And that might impact when we start doing modeling with the severance tax, ultimately when we do our asset allocation. So I think we talked about that. The other is, as you see these potential returns, you can see why you can't invest yourself out of the hole with returns like this. And you also see where stretching for a return of 7 or 7.5 doesn't sound like a big deal, but it's a big deal when that's all you have to work with. And so you say, what's the magic sauce that you're going to get there with these returns? And that's what the annual plan will be, is what is the magic sauce?
I like the idea of making sure that we we reflect those differences from 1 to 2% and be able to look at where we are. So if we could do that, I don't know if that's okay, I'm sure it's fine with the council members, but I appreciate that suggestion. Peter?
Just also pointing out the obvious, I appreciate those comments. We are not hitting 7%, because that's where the markets are not bringing us. That means our distribution at 5% is certainly at the top of where it should be, if not too high. So as people talk about, why can't we just take more money out of the fund? The reality is right on these charts. So we have to be sure that we understand that.
There might be some differences in opinion about that, Peter, but I think we ought to have the information so that we're all looking at the same thing. But thank you.
Yeah, and one of the analysis, and I think we may bring this as part of the annual investment plan, is that we've looked extensively at it's a bit of a nuance, but the difference between a distribution percentage and what that actually means in dollar terms. It's quite interesting. I think the break-even point was somewhere in the high teens, about 18 years out, where when you actually spend a higher percentage, your dollar distributions actually sort of don't pick up more than if you were to spend less, because you allow the corpus to grow more. So even though you're only spending, let's say, 4.5% compared to 5%, because the corpus grows that much quicker, you're actually distributing more dollars. And that can take a decade or two to get there, but there is an upside if patience allows that type of an activity to actually get more dollar distributions with a lower percentage. So it's something to perhaps include as part of that investment plan. Page 147, I want to make sure we make good time here, shows that in the orange dotted line, that's exactly the land grants return expectation currently of 7%. And you can see that emerging markets is just above it. International equity scratches at it. And then you've got some of the other asset classes below that, not surprisingly. Fixed income, which is denoted in green, is towards the right-hand side of that. But a lot of these have been increasing as interest rates have been generally moving up, although this year's been a little bit of up and down. So if there's no questions on,
Yes, sir. Thank you, Scott.
I must be confused here. On page 149, we show a standard deviation of 12.6 and some change. That's the entire land grant, all assets, correct?
yes,
Back on page 34, there's another chart that I must be looking at apples and oranges. It shows that standard deviation is 5.32. What's the difference that I'm missing between page 34 and 149?
34?
Yeah, page 34 earlier.
So this is, 34 is representing the actual, what you've actually experienced for your volatility.
It's the whole, all assets, correct?
It is, yes. So it's actual, in the performance report up front, that's what you've actually experienced, what type of volatility over that time period.
Okay.
Arguably, that's been artificially low if you look at what volatility is down since the GFC. Yeah, and this volatility expectation is what we think going forward.
So we're, in essence, with our estimates moving forward, we think that risk is gonna more than double. Am I interpreting that right?
We expect it to revert back to the mean, yes. So it's been low, whether it's been half of what it should have been, but it's definitely been lower.
Okay, thank you.
Any other questions or comments? Thank you.
Okay, great. 148, just quickly asset allocation overview before we dive into the actual numbers. As we talked about, once you have the assumptions developed and finalized, then it's more a matter of selecting which of those asset classes you want to consider, and at what weightings, and what ranges that you'd like to consider them in order to meet the objectives that you've set for yourself and the fund. And so I think the only other thing here that we'll add, and it's really the flip side to 90+% of the return coming from strategic asset allocation. Manager alpha or outperformance, the managers that you select certainly help, but they're not going to make or break it. So I think there is a tendency to spend a lot of time on managers because they're very visible. But ultimately, this type of discussion that we're having today is where we all should focus our time. So with that, maybe we'll look at land grant on 149. And here, no changes or recommended reallocations. It's really just looking at what has happened in terms of 1 year gone by and the expectations on the total portfolio as a result of that. We have listed in green the interim, and the interim has continued to converge with the long term. That's part of the implementation of that long-term target allocation. So you'll see that there's some differences within the interim year over year, and you can see those highlighted on the far right-hand side in both green and orange, the pluses and the minuses, to see where the percentages have gone. But really, it's the blue that probably we ought to focus on, and that long-term target has not changed. In terms of 2019, what we are anticipating is approximately 12 basis points of additional arithmetic return, so that's the average return, really not much to look at there. But the compound return, arguably much more important, which is 6.41 versus 6.29 last year for that same portfolio. So we are about 60 basis points shy of that 7% return target. Now, just like a pension fund, you don't have to have necessarily that exact return each and every year, but over the long term, you should be on target and on track to hit that. Otherwise, you set a target for yourself that you'll never reach, and are making suboptimal decisions as a result of that. So it is something that you don't necessarily have to review and change on an annual basis, but you should check in on to see if there's enough time has passed to warrant a review of what we think that the portfolio can reasonably earn over the long term. In terms of the yield, the other component there, you'll see this is the third line from the bottom. It was 3.64 for that same portfolio in 2018. It's improved to 3.9. So now more than half of the total return expectation comes from income. That's good. That provides some stability and provides you with some drawdown protection. You see your max loss as your 1 year first percentile return. So what if we had another 2008 type of return experience could we expect for the total portfolio? You see that somewhere in the negative 30. That may be a little bit high, but is indicative more in terms of what the trade-offs are from taking on more risk. And then at the very bottom, you have the probability of meeting your long-term return target of 7% over a 10-year period, and you can see that currently at 46. Ideally, we'd like to see that at 50, which gives you a 1 in 2 type chance to hit that. So overall, the portfolio with really not making any changes, just from what's happened in the capital markets has improved modestly. I think the return being going up, volatility essentially remaining the same, and income or the yield component increasing are all positive aspects of this portfolio. The probability of meeting your 7% return target, that's something that has been below, and at some point we need to make a decision as to whether we look at that more closely or not. I'll pause for any comments or questions for the land grant.
Any questions, discussion, concerns? All right, proceed. Oh, I'm sorry. Thank you, Peter, for recognizing that I missed Senator Ross.
Well, I was just gonna say, if we can't get more returns, we're gonna have to count on Stephanie giving us more money.
I'd like to just sort of approach this as that we want everyone to give us more money. I don't know why we can limit it, but my expectation is everyone gets us more money to prudently invest on behalf of the state of New Mexico. So thank you, Senator. Anyone else? Thank you.
Maybe before I move on to the severance tax, I'll point you to page 155, and I'll only do this here so you know that these pages are in here, and highlight, I think, 2 things that we've done based on some feedback received at the CIC. You'll see on page 155 that this is the efficient frontier. One thing that's new here that we've done, and I've discussed it at length, is rather than showing the average return, showing the geometric or compound return. And here you can visually see what I've talked about in terms of the disincentive to taking on more risk. So you can see that on a compound basis, that very last dot is actually below the 9th dot. So it means there is certainly a point of diminishing returns in terms of assuming more risk. And at some point, so we know that the risk sort of in many ways increases exponentially, but it does so in a way that it eats away at that return faster than what you're actually gaining. The second component is the 70-30. There's been a lot of talk about what does a 70-30 portfolio look like in our return expectations. Vince mentioned how low U.S. equities are. Fixed income is improving somewhat, but nevertheless, it's quite a ways off the efficient frontier. Now, again, it's been a portfolio that's done exceedingly well over the last 10 years for all the reasons that I think we've discussed. Easy money, sort of what's happened in terms of CFOs restructuring balance sheets on the corporate level. Lots of things that have helped the 70-30. If you're a believer that will continue, then that might be a viable strategy. But in terms of our expectations, we think it's a good ways off the efficient frontier. So I just wanted to highlight.
Yes, you can, Vince. Thank you for asking.
Thank you.
I just want to make sure that we recognize who's talking for the recording. So I know it seems like I'm being, testy first thing in the morning, but I just want to make sure that we're getting it accurately for those who are viewing and listening. Thank you.
Well, the discussion earlier was on the compound space, we're a little bit below the 7% expectation. Now there's one technical reason why it's probably a little lower, as Matisse pointed out, we showed you the -30. There's a technical reason that's probably aggressive, but what I want to show on this, or what I want to point out on this chart is where the blue dot is, where our long-term allocation is, it's about as far as we can go out that risk curve before it really starts to flatten out, to where we're not getting hardly anything more in return for taking that additional risk. And if you think, is now the time to take additional risk? Is now the time to push this out just so we can have a 7 number in that column? Probably not, given valuations, given how deep we are in the economic cycle, a whole bunch of reasons. why now is probably not the time to push out that risk curve. So when better times come in terms of future expected rate of returns, it's going to be bad times, probably economically, but when we can forecast better expected rates of return, so more normal 9 to 11 on stocks and more 4, 5, 6% on bonds, those type of numbers, then we want to move out that risk curve. And I guarantee you, when he shows you that chart, in that kind of market, it'll have a much steeper slope. So we can move out that risk curve a little farther at a time we can get paid to do so. Now, I showed you in the liquidity plan a couple of years ago that we have a plan for that. That's the 10% of your portfolio that sits in core bonds. When the next recession comes, when we see stocks down 35, 40, 50%, we'll move all 10% of that very low risk money into these risk assets and we'll move out that curve for you. You'll see a section in the annual investment plan. We put it in there last year, we'll put it again this year. That'll actually show you what we think a curve possibly could look like and where we possibly could go on that kind of curve. So now's not the time to be pushing out. I know that number says 640 or 649, and we're targeting 7. That 7's a long-term number, and when we get to a good spot, we'll push out that risk curve and make sure we try to make that.
Thank you. Any responses to? Right, thank you.
Okay,
Proceed.
page 150 takes us to the severance tax. Again, they're similar story to the Landgrant that we just looked at. Similar portfolio with some minor differences really related to the private assets and the in-state program there. So you can see an expected compound return of 6.4. That's 9 basis points better than the return last year of 6.31. You can see that the yield has also improved by about 30 basis points, although similar to Landgrant at 3.71, and as well about half of the total return expectation, a little bit more actually. And then the probability of meeting the return expectation over 10 years is a bit higher, it's at 49, but it also has a 25 basis point lower return expectation with a reasonably similar allocation. So that is one of the differences there. So no recommended changes to either of these. It's really just for your information. But again, I'll pause for comments or questions on these two before we move into the next two that actually have recommendations around. Yeah, and I think to Linda's point about trying to further isolate the impact of SBIC and New Mexico private equity program, we are working with staff to identify what type of assumption makes sense for that part of the portfolio. But that is a more nuanced and complex process than I think we initially anticipated. So once we have good assumptions, and I think we're a little cautious because garbage in, garbage out, we don't want to just throw a number on it. We want to make sure that the number is good. Once we have that, we should be able to help provide you with expectation on impact for those. So it's certainly on our radar.
Any questions, comments? Okay.
Okay. Page 151 takes us to the tobacco review. Again, all of the additional information is in the back. If you would like to see that, the CIC has discussed in great detail. I do need to point out that this is there's a typo here in the blue box. It says potential 1. It should say potential 2. Everything else is correct, except that. So if you would just maybe note that for the
Sorry, Peter, go ahead. We want you to repeat what you just said.
yes, potential 1 should say potential 2. We are showing in fact potential 2. It's just the heading is incorrect. It's a typo. That 1 should say potential 2.
Is that clear to everyone? It's a typo. We haven't changed strategy recommendations. It's just a typo in the handout.
Correct. So the motion, everything else is accurate, as is the data. It's just the heading.
And that's reflected on 164, it shows potential.
So you can see in green the current allocation, and in blue the recommendation put forward by the CIC for potential 2. You can see some differences in the reallocation. Currently, it's a fairly straightforward portfolio with about 2/3 in publicly traded equities and the balance in traditional and non-core fixed income. Much of that traditional exposure is being reduced under this proposed potential 2 in favor of higher yielding alternative assets. So you see the US equity, international equity, and fixed income being decreased, the percentages on the far right-hand column, and in favor of the New Mexico specific alternative asset classes that return quite a bit more and have some correlation benefits. As you slide down into the next section under the gray bar that says capital appreciation, preservation, alpha, and inflation, those are the thematic categorization. You can see that it's a much more balanced portfolio under this framework. In terms of what that does, and Vince already explained some of the rationale for what was driving the changes here for the CIC to select potential 2. But you can see the return differences are essentially the same average return, 6.66 versus 6.63, but the risk is substantially lower. So you're getting the same amount of return with significantly less risk, and as a result of that, your compound return increases by pretty decent margin to 6.21. In terms of the efficiency of that portfolio on a risk return basis, that improved from 0.5 to 0.7. That's quite good. We see the equity beta decreasing. That's also good. You're not beholden to the publicly traded markets. And we have the liquidity metric, which is lower, but again, that liquidity metric is really more illustrative and not entirely representative of what your liquidity would be in this particular area. The annual yield also improved by a substantial margin, almost 1.5 to 5.15. So you can see the bulk of the return is coming from income. So you've got a good deal of stability there. You've made material improvements on your downside risk, taking off almost 6% off the worst case scenario, and the probability of meeting a return target is essentially the same. So by most metrics and by most counts, this is a materially better portfolio, and certainly seems to meet the objectives that we understand this portfolio has. So that is the recommendation of the CIC. Again, we looked at 3 portfolios. All of them were reasonable portfolios, and we felt that potential 2 was arguably a good choice by the CIC.
Any questions or comments? Okay. We want to do a motion and the action item based on that report, or have the second report and then go back and do both? I'm open, Linda, to what you prefer.
My recommendation is that we go portfolio by portfolio and do tobacco first and then what we do water.
Okay.
So, based on the recommendation of the SIC staff and the General Fiduciary Oversight of RDK, I move that the State Investment Council approve the asset allocation potential number 2 for the Tobacco Settlement Permanent Fund, as discussed, reviewed, and memorialized by the council today.
Second.
All right, we have 2 seconds at the same time by Peter and Harold. Good work. Is there any discussion? Any comments? Seeing none, all those in favor of the motion say aye.
Aye.
Any opposed? Any abstain? The motion carries. Thank you.
Great. Page 152 takes us to the water trust, and this is the final item for your review and consideration today. Vince provided the introduction to this particular fund, and I think one of the interesting things is the 4 million annual distribution. That is a stable distribution, but it also represents almost 10 or 11% in terms of the NAV of that particular fund, which is a very high and not a distribution not sustainable by investment returns alone, to be sure. So the need to earn return here is arguably higher than anywhere else, although again, I would make clear that 11 to call it 12% annual distribution cannot be supported solely by investment returns, no matter how good your staff is. So you can see here the changes. It is a more diversified allocation already than what you just reviewed for tobacco. You have exposure to essentially all the asset classes, but there is an opportunity to refine this a bit more. Not unlike what you saw for tobacco. There's a reduction in some of the publicly traded or traditional asset classes with public equities, US and international, being decreased to below 10%, which is a neutral weighting. You have your fixed income decrease as well as your non-core fixed income decrease in favor of some of these higher yielding and higher returning asset classes. So real return, real estate, and private equity are receiving the bulk of those percentages. In terms of the thematic diversification, next section down, it's better, but you do still have a fair amount in capital appreciation, or at least what is deemed just straight capital appreciation. Some of these buckets are really, or some of these asset classes really straddle multiple categories here, so it's not, unfortunately, it's not as clean as one might want it to be. In terms of the actual flow through results on the portfolio, you can see down below, expected arithmetic return, we're picking up about 50 basis points in anticipated or expected return, but you also have higher risk. So the risk is increasing by almost a percent. But in compound space, where we combine these two numbers of what that actually means, you still see meaningful improvement, almost 40 basis points from 6.3 to 6.66. No material change on any of the characteristics below, because again, you have some movements both on the risk and the return basis. A little bit less on the liquidity. Again, though, that's more illustrative than actually binding. And then you can see the bottom section there. Again, the probability of meeting that target return, I think that's helpful to review, 11%. So essentially next to nil, given the current economics of that particular fund. So it is a marginal improvement, but I don't know that there's any investment strategy that would necessarily bring this back on, at least currently on fiscal sustainability.
All right, Peter?
So, Vincent, I know it's fairly minor, but how are we funding the annual cash distributions from this fund?
Well, typically, there's been just change in the portfolio. It's been pretty easy to do, but it's so small that normal cash flows that happen every month if we need to sell something. But rarely do we have to go hit the markets to get cash.
But we're basically selling across the board.
A piece of the portfolio across the board. If I can just.
I'm gonna go to Vince, and then I'm gonna go to board member Harold Lavender. Go ahead, Vince.
One thing to note on this potential three, I mentioned that we felt like we could take a little bit more risk. The potential three does have a little bit more risk, but let me bracket that for you. Let's get in terms of what more risk means here. The most aggressive or public funds today run about 14 volatility, so that I'm looking at that 12.9% expected risk standard deviation in the potential three column. The most regressive funds run about a 14 vol. Average is about 12 and a half, 12 and a quarter. Land grants around 13. So that makes up less on land grant now with the present allocation. But so when I say a little more risk, it's just a little more risk. We're not anywhere off the charts or anything with this, but we've taken more risk with this portfolio we have.
Okay, Harold.
Since I joined the council a few years ago, we've been wringing our hands and gnashing our teeth about the size, the difficulties of this fund. And I want to, it seems to me that it would make sense for us to, is there a solution to fixing this? Maybe legislative? I'm just wondering what the situation might be. But we every once a year, we agonize in a sense over what's happening. I mean, it's clear this is going to go to zero in a reasonable length of time. I mean, it probably will, unless something crazy happens. And is there a reason for us to potentially seek a solution legislatively or executively to figure out a way to refund this? I don't know the answer. I'm really posing the question.
If I might, just in a general sense, there was certainly some discussion in this legislative session by Senate finance members primarily in the context of funding early childhood education, that with the number of small funds that don't have the kind of money going in, but money going out, trying to manage those productively, should there be a conversation legislatively with recommendations about what to do with the number of funds? This fund was not specifically, I don't think, John identified as one of the funds to take a look at, but in general terms, that was a fairly robust conversation at the very end of the legislative session, for what that's worth to council members as we determine whether there's a position we may or may not take with regard to those efforts by other policymakers. Thank you, Commissioner. Stephanie.
And I would just invite you to just chat with Senator Cervantes about his attempts to change the.
The water.
Any other comments, suggestions? I mean, when we get to that order of business, we might talk about whether we want to have a discussion about options at the next meeting, which I would be open to, and I think other members would. I mean, we ought to, in addition to making sure that we're managing those investments and that we're clear about what those strategies are, whether we're meeting our targets, I think it is also prudent and we should take advantage of those opportunities to have those conversations. So thank you, Harold. I think if that's, when we get to that item, if members don't object, we'll add it to the next meeting. Okay, Senator Jennings.
The only thing on changing that water trust politically, it could be, I think it could be pretty difficult to do. Somebody's gonna look and say, that, you know, you're doing something bad no matter what happens. And so, I mean, I don't know if you can add to it, but taking it away, you might get some.
Right. I mean, I think that that's largely, Senator, what people would do is identify the funds that don't have a specific, maybe intended purpose anymore, look at whether there's a distribution or allocation from the legislature into funds that we know we need, and equalizing and getting a 50-year water plan, which is certainly something that I've proposed and will get done. And what that really looks at, like, causes a great optimism and great grave concern about where you might be going in a state that's, in my opinion, based on scientific evidence, that we're looking at aridification, and we ought to think very clearly about what our water resources look like and don't look like, and what our investment strategies related to that ought to look like as well.
We also need to look at the value of the fund when some years from now it only grows $38 from $339.
And what it costs to be managing it. I mean, that's why I think it's a valid point that Mike's made. And again, I don't want to speak for the entire council, that's just my reaction. Anybody else? Linda is ready for her motion. And thank you, Linda.
Based on the recommendations of SIC staff and the general fiduciary oversight of RDK, I move that the State Investment Council approve the asset allocation potential number 3 for the Water Trust Permanent Fund as discussed, reviewed, and memorialized by the council today.
Second.
We have a second. Any further discussion, questions, comments? Seeing none, all those in favor of the motion as stated and seconded, say aye.
Aye.
Any opposed? Any abstain? The motion carries. Thank you very much. Thank you for getting us through item number 3. We're now on item 4. We're going to have the CFO report. Brenda Schick, you're up.
Governor, I will just make a couple of points and I'll be done. I'm on page 204 for those of you who are undiligent. This is a summary of the budget to actual for the fiscal year. It is prepared as of the end of April. If you go to the far right-hand column, you'll note that we're likely to finish the year in all the budget categories at a surplus. I would expect these numbers to change a little bit, probably go up some, but not very much. So we will be finishing the year at a surplus. For those of you who are new to the council, that surplus as part of the audit is reverted back to the original funding sources, which is the land grant payment fund and the severance tax payment fund. Next, if you could just go to page 229. I think Steve already mentioned this. I just wanted to point out again on the first bullet, you will note that the distributions or the inflows from the state land office for April was $71.2 million. That is an increase over the prior month of March of $9.1 million. That's about a 15% increase month over month, which is substantial. And then if you compare it back to the prior April, that increase is about 20%. So very optimistic about the inflows in the future. And then I think someone made mention, if you go down to, I guess it's the bullet, the second bullet there related to tobacco severance permanent fund, we will or have already received inflows of $34.7 million related to that fund. We are expecting, since we've been notified by DFA, about half of that will go out as distributions in June. So we'll be maintaining about half of it and then distributing about half of it. And then lastly, I'm on page 230. This is the distribution schedule for the beneficiaries, and I wanted to just point out a couple of things on this so everybody kind of has a feel for how the schedule works. If you work from left to right on the schedule, it starts with the prior month-end balance of the fund, and it kind of rolls the numbers to the current month-end, which is the right. We mentioned the land transfer, which was $71.2 million. That's under the land transfer column. And then lastly, on the income distribution, the $62.29 million, that's the distribution that goes in monthly. We calculate at the beginning of the fiscal year, the annual distribution, that monthly distribution is 1/12 of that. And then finally, and my last point, on the far right-hand side, you can see the various beneficiaries and their percentage ownership in the land grant permanent fund. I was looking at this early this morning, and I know in the past Senator Jennings has made a comment, but besides the common schools, which is the largest of the beneficiaries, what would you, without looking, what would you think are the 3 or 4 next highest beneficiaries on that schedule? I was somewhat surprised. I think the Military Institute is one, School for the Deaf is one, School for the Blind is one, and the Pino distribution is the other. So something to keep in mind going from month to month. You wouldn't expect those distributions as far as the size relative to all the beneficiaries to change as much. So if you pull up a month and those aren't in the top 4 or 5, and probably something's wrong as far as the schedule is concerned. But that's all the comments I have unless there's questions.
Yes, Senator Jennings?
Does everybody know why?
I think there's an appetite for you to tell us. I don't know if you
Because
can stop you.
all the big universities got all the real nice farmland and everything else. The only thing left for the institute and the penal institutions and the school for the deaf, and with crappy old land around Hall.
Madam Chair, if you ask
Yes,
General
ma'am,
Grizzle,
Commissioner.
he will tell you that they gave the cowboy school all the lands nobody else wanted. Turns out those were the best ones.
See?
It was a long time coming.
Yes.
In the prior year, we received the land commissioner's annual report, and I found it extremely interesting. I wonder if we might receive the current report whenever it's published.
So
I know
Madam
what
Chair,
cycle that's on, but it would be helpful.
Certainly.
so essentially that comes out right at the end of the calendar year, just in time to be right before the legislative session, but absolutely it's, it's set in statute, and so I will ensure that council members receive that as well.
That's great.
Thank you. Thanks, Lauren. All right, anything else, any other questions or comments based on the CFO report? All right, Mr. Shipp, thank you very much. So So we are now on item 5, which is an action item. It's a discussion and vote. It's on litigation matters, State Investment Council versus Bland et al. On page 231 in your materials is a memo by Bruce Brown, who's the Deputy Chief Counsel, listing out reasons for entertaining and approving the settlements. I wonder if council members want Evan to take us through that. All right, let's do that. So we'll have our chief counsel sort of take us through that memo, and then if there are questions, concerns, we will deal with those after that presentation. Evan?
Okay, and good morning, heading to good afternoon. So I'll try and explain what we're doing and why. And sort of piggybacking on the governor's comment when she said everyone gets us more money to invest on behalf of New Mexico, that's a big component of what we're trying to do here today. So first, you have for you a public vote, a public record, and we're trying to do everything in open session regarding this litigation that you've all heard about for the last 9 or so, approaching 10 years.
Okay, I might be, can I interrupt you just 1 second? We are not discussing litigation strategy per se, otherwise we would entertain a motion to go into executive session so that we don't minimize the ability to protect the council and the public's investments. Now, this is at the end of all of that effort about a potential settlement. I just thought for the record, you might want to set that aside, and this in fact should be in a public session.
Absolutely. So you have a 5-page approximate memo that's public, which explains in detail what we're trying to do specifically and why in terms of the settlements. And we're going to try and obviously do it in open session, and we've obviously followed all notice requirements and so forth. Why are we bringing it now instead of waiting a month? We're bringing it as soon as we could, when we had the components of these settlements that we wanted, because waiting months cost thousands of dollars more every month. We have hearings, we have to travel to them, we have bankruptcy proceedings that we have to attend in local council. It's costly. And so we brought it as quickly as we could. And incidentally, we got the final docs on last week, and that's why we turned it around so quickly. So there are 2 components to this settlement as we think about it as staff. The first is don't let people off the hook in an inappropriate manner. And 2, maximize your recoveries. That's really how we think about it. The first one off the hook is easy, and that's why these settlements are pretty easy from the staff recommendation. When we started out, there were 20 or so targets. You know, we chased people for years, we chased entities for years, you see many, many settlements, it's all public. And there were 4 individuals left, and those are the 4 individuals that are the subject of this memo. And all, in varying ways, have either agreed not to contest liability, agreed not to appeal a finding of liability, or agreed to actual liability in the case of 2 of them. And so they've effectively, in my mind, and it's my view, and I know counsel here as well, who are deputized by the AG's office, have waved the white flag. So what this settlement is about is how to move forward and how to maximize recoveries. And the reason we staff are bringing this, Steve and myself and Bruce and Kenred, is that we believe strongly that by bringing this settlement today, we will maximize recoveries, and that is monies in versus expenses on a net basis, significantly and materially more than by protracted litigation, appeals, the expenses related to that for years. And so, and we believe that that magnitude will be in the millions. And the reason I say that is, if you look at page 205 of Brent's spreadsheet, which was his budget, legal expenses are in the millions. And frankly, one of our defendants has left the country, and the whole issue here is collectability. And so, without beating this memo to death, I do have hard copies. If anyone would like to look at it in hard copy, that might be easier. But this is a straight collectability matter, and we strongly recommend taking money today so that we may invest it and moving forward. And again, this is not liability. We have all these settlements, and you have all the terms. We've given you all the rationale as well as all the terms. It's a straight collectability monetary matter in our mind, because again, the liability either contesting, appealing, or otherwise admitting or taking care of in these settlements respectively for each defendant.
And before I open it up for questions, I might just point out that, or I want to highlight that we waited until we had financial statements so that when you're making a settlement, it's not just in good faith between, and no offense to the counsel involved on either side, but rather we're looking at factual, financial information related to whether or not we can collect on any political debt. That's important to me. I would assume it's important to council members, and it's required to do due diligence on behalf of the executive staff for the State Investment Council. All right, so we, I saw Lynn first, if that's all right. Lynn? Go ahead.
Thank you, Governor. Further to your point, and it's clear in Evan's memo, that if those financial statements are materially false, all bets are off. The settlements are no longer binding. So I think the emphasis is on collectability, on, reliance on the validity of these statements, and if they were not valid, we would have to recourse. Correct, Evan?
If you don't settle, you go to trial, you could lose, I mean, it's just a possibility. Then there are appeals, and then you gotta chase money wherever it may be, potentially years from now, in whatever countries that may be. And yes, and but specifically to your point, they are conditioned on truthful financial statements.
And it's actionable, as you pointed out, a very serious actionable component if in fact they're not materially correct. Now I've got Senator Lawson and then I'll go to Scott.
Just several questions, but the first one is, what's been our total legal cost? In other words, you don't get a $19 million judgment, but that's meaningless because we're only gonna get $6 million recovered. And as you already noted, that we've had substantial legal costs incurred. And I know that the legal costs go for a whole spectrum of efforts, not just these four. But would it be possible, and you might not know now, but to get a report as to how much of that $6 million we've actually going to have expended to collect the $6 million?
Well, let me answer the question as best I can, and if you'd like additional detail, I can get you that as well. To date, in our pay-to-play recovery litigation, in terms of monies received and or escrow waiting pending various proceedings, we have about 20 different parties, individuals that are involved, and we are in excess of $50 million. Some of that's being released from escrow. You add this to it, and there's some components of the bankruptcy court getting paid, and there's some complexities, you're probably in the neighborhood of the mid-50s on a net basis. In terms of expenses, what you're asking, we pay two ways for this litigation, and pays the wrong word, but there are two financial components. The first is Dave Pitney, the outside law firm that's been deputized by the AG, gets a 20% return on the recoveries, subject to certain thresholds, and we pay expenses. And so if you do the math, and some of it, I don't know exactly what's going to come in and what falls under Dave Pitney's agreement, so it's going to be less than 20, it's not going to be 20% of 50 million, it's 20% less if we've done some independent stuff. So Dave Pitney will get several $1 million, frankly, and we have paid in their expenses also several $1 million, less than 10. And so in terms of numbers, you're 20% of the total recovery ballpark is probably going to be fees and expenses related to this case, which is a pretty good result, all things considered, all in. So your net is probably in that 40-ish, 35 to 40 range, if I had to guesstimate, which is still a substantial result, and that's probably an overestimate.
So out of the 19 million, we would be expecting that we might net 4.5 if we were to take that analysis equitably across the board, because we're not going to get to 19, we're only going to get 6 if we can't,
It's sort of an unfair characterization in that you're parsing only the 19. We have gone after every money source we can from every place. We have forced one of these individuals into bankruptcy, federal bankruptcy, for which a criminal offense to make a lie. Another has a $2 million lien on their house versus a $90,000 liability to us. Another has sworn to poverty. And as to some of the other monies, there was a divorce, there was money that left the country well before any of our time here 10 years ago. And so if you want to think about it in terms of one party, you're getting a substantial portion of their assets, and if you went to trial, you get nothing, because they're.
But I'm just saying, reality is we're getting about 3.5 million, probably, 4.5 million of the 6.
I think at a net basis, yeah, I mean, by the time folks are paid, it's over, but I'm not sure.
Okay.
That's a fact number.
The next question would be with regard to Bland. Is he getting PERA? And if so, what is he getting? Because he keeps talking about his monthly cash flows are negative. I keep thinking, well, we're still probably paying him because that was before, I think, we passed legislation so that you wouldn't have access to that. So is he getting PERA, and do we know what that is, or can we find out?
He is, I believe he's retirement, and I can say that number.
Yeah, I'd like to know. I think that's the public would like to know, is here you get a guy that's been involved, and we'd like to know how much this state continues to pay him. Okay, the next question would be really back to the question that Lynn raised, but in terms of the validity of the financial statements, and there's potential upside if they've been fraudulent. Is there going to be any effort, or how would we even begin to pursue the validity of them down the road if something comes up? I mean, are we just going to say, yeah, we trust their validity, we're done? Or are we actually going to make an effort to go back later?
I've seen no evidence, I don't believe our council has to suggest anything in this meeting, but we're getting into.
Yeah, I have trouble with that, Senator, for a multitude of reasons. This is not a criminal investigatory body at all, and what you are raising is far beyond anything that we should even be undertaking. Somebody has an issue, that goes to the AG's office or somebody else, and they cannot represent us. If they are not being diligent, they are our fiduciaries and our legal counsel. If they are accepting anything that they think is not accurate, then we have actions against our very own staff and our lawyers. I don't think that's the case, and I'm ready to defend you, Evan, maybe, we'll see how this goes. But and I appreciate where I think you're headed. But we want accountability and transparency in every public sector. This body and the state will meet its fiduciary and transparency requirements, and I feel good about this body doing that. But beyond that, if there is an individual who doesn't believe that there's been productive legal advocacy on our behalf, then that would be something we should discuss in executive session.
Well,
We are not a criminal body.
I just wanted to follow back up though on one of the two commenters, or the two comments, but the 2 points was, one is not to let somebody off the hook, and 2 is to maximize the benefit. And I appreciate that. And one of the 4 individuals is not paying anything because they're just don't have anything. There's nothing to chase. But we still pursue the judgment against that individual, which is, okay, which is fine. I think that's what we should do, but that's different than the council was willing to do against Smiley. I just want to point that out.
You're getting into privilege stuff, but I'll answer it this way. You get less money tomorrow than you do today, and you're a fiduciary, and that's why it's my recommendation.
But we also, the point was, we were trying to hold all those 4 individuals accountable, at least getting a judgment.
Yes.
Right? Getting some sort of plea. We agree that
No,
we.
not a plea.
Not a plea, but
Yeah,
some sort of.
you're going into a whole different direction, so.
Okay, that's, yeah, I don't know the legal terms, but at least we got a judgment against all of them.
We have different ways to admit liability, if you will, and I want to be very specific because the agreement speaks that you have them. 2, the Carreras agreed to a judgment of $18 million, so that's your question. As to the former state investment officer, he has agreed not to drop an appeal of a finding of liability related to his fiduciary duties. As to one other Reardon, the settlement is he agrees not to contest a finding of $90,000 or so. So in substance, they have all waived the white flag, and it is straight collectability, which is what these settlements are about.
Correct. All right, I think Scott, you were next, and then Senator Jones.
Thank you, Governor. I'd like to start off by, this has been a decade-long effort, Paul, you've involved in the room, and Dave Pitney, kudos. 8 million pages of documents, this hasn't been something that took a little bit of time, took a lot of time, so kudos. I don't know where this ranks on recoveries by the state of New Mexico, but in that $55 million range, it's got to be a rather large one. There was a party that a while back was making some, under the whistleblower theory that party may have had some rights to some of these funds. Has that completely resolved itself, or are there still some issues with that still dancing around?
I think there will always be issues because attorneys can file whatever they want. The current status of those reported whistleblower claims are two, really. One, the court in that specific action, which is Judge McDonald in Albuquerque, although it's technically a first district case, has thrown that case out. And it's on appeal, and in my judgment, is unlikely to be overturned on appeal. The second component of that is the whistleblower tried to intervene and participate in our case, which is the case we're settling, and our judge threw the whistleblower out. So there will be some appeals and some inflammatory statements, but they are totally dismissed at this current point of the proceedings.
The only reason I bring that up is if that individual were to prevail, which seems highly unlikely and always has, these funds would be affected by that. Was the only reason I mentioned that. I believe, I don't know if that's entirely accurate or not.
It's possible.
I suppose it's possible, but there are offenses and so forth.
Yeah,
I
but
can't
not like-
speculate as to that.
Thank you.
That would be a privileged sort of analysis.
Senator Jennings.
How would you ever find out if any of these individuals' financial statements or that they give you are fraudulent or misrepresenting that? How would anybody ever find that out?
Well, for one, they file tax returns potentially in New Mexico. I don't know if we have access to that information, just thinking off the top of my head. Two, it's federal bankruptcy. If they've lied, I mean, that's a big deal.
They check.
And we've done the best we can, and that's all I can tell you. I don't know of any efforts that we could have done or that Dave Hickey could have done there, or anyone for that matter. And again, Dave Hickey and Bruce are deputized by the Attorney General's office. This isn't just our staff running wild. And one other anecdotal thing is, remember Ross made the point about the agenda in the beginning. And what I was thinking was, this is a settlement of litigation, but the reason it's down lower and tends to be is how we think about it. It's not that it's less important, just monetarily. You're talking a $25 billion fund, so the investment decisions that are upfront relate to the $25 billion. And we have known nothing about additional assets. There might be, there might not be. I can't legislate or govern ethics, but we got the penalty. We got a protective right, is how I describe it. If they lie to us and we find out about it, or you find out about it, or somebody tells us about it, we'll pursue it. But until
They
that
have
time,
a liability, a criminal liability, and we would,
some do in the
yes.
bankruptcy.
Some of them do.
But for like the Carreras or any of those guys, they wouldn't be filing income tax in this state because they don't have any income here, right?
Again, we're talking.
The only way to use them.
The response is the same. You get less money, we think, if you don't agree with it, because we've done the best we can based on sworn financials. And, if we don't, then you have to pay for litigation, you gotta pay for.
Your legal bills are gonna eat up whatever.
Correct.
Right.
But it doesn't matter
Correct.
damn what you do.
Yeah.
Right.
You'll get another $1 million, $2 million here in here in legal bills, no matter what.
Yeah, but that's why I keep talking about the 50 number. When we talk about legal bills, we've done a pretty good thing, in my opinion.
You always gotta look that up for lawyers.
I don't get paid, by the way, but,
All right. Senator, you're done. All right, so I've got actually, Linda, you're not gonna make a motion, are you? Peter's willing, I just wanna make sure.
No.
You got a, okay, proceed.
I just want to say that this was an incredibly complex litigation over a long period of time with many defendants and many different court actions. And this kind of brings it to a conclusion of anything that would be litigated, except on appeal, if that would be argued. And I think this is just a very, very sound and prudent final settlement. And it's certainly gives us the amount that we think we could possibly get, but yet the practicality of what we think we're actually really gonna get. And it's combined the two, leaving that liability still available to us if we find that they actually have more assets than we think. So I think this is a great solution, and I really applaud all who have worked on this, because it's nice thing to have off of our back, and I believe that $55 million settlement, even compared to New York, is very favorable. And compared to other states, it's phenomenal. So I think we've done a superb job, and it's a good time now for our energies to go back to the 25 billion.
Thank you.
I was prepared to make a motion, but I defer to help.
Based on the recommendations reviewed and discussed by the council today, I move that the State Investment Council approve the legal settlements with Mark and Anthony Carrera, Gary Bland, and Guy Reardon under terms memorialized in the public meeting materials with additional signatures and any required finalization paper as needed.
Second. We have a second. Any further discussion, questions, comments? Seeing none, all those in favor say aye. Aye. Any opposed? Any abstain? The motion carries. Thank you very much. Thank you, Peter. We are now on item 6, closing matters. I'll open it up. Does anybody have any old or new business, which is item A? A couple of things. We want to keep talking about permanent fund investment strategies and what that looks like. And I'd love to talk about what we spend in public places and analyze that. We're going to change some of the reporting aspects. That's been, I'm sure, characterized in the minutes. And the land commissioner is graciously agreed to make sure that every member gets a copy of your annual report. When that is done, did I miss anything as a recap of this meeting or prior meetings? All right, so seeing no anything old or new business, the 6B is the next State Investment Council meeting is Tuesday, June 25th, 9 a.m. here in the Cabinet Room. We are now on item 7, which is public comment. Do we have anyone making public comment this meeting? Yes, sir.
Kenneth Grano, investing. I just want to, I put out on social media what was going to happen today, land issue. I got quite a few emails. I would recommend that the link to the stream be on the home page and not be buried because they had a hard time finding it. So that, and one of my recommendations is that it automatically stream on that home page the day of the meeting. The other comment that I got was there's a lot of documentation being spoken to, and you have no reference to it. And I don't know how you resolve that, but so those were comments from, I put it on LinkedIn and I put it on other social media. I had quite a few people that were interested, obviously, in the land issue that got reared. And just, Governor, so you know, I've been coming to these meetings since Gary Bland was here and this whole issue was resolved, or this whole issue became an issue. And I'm glad it's resolved because it has had serious consequences to investing in New Mexico companies. And without getting into specifics, I think the staff knows what I'm talking about. The other thing, Steve Moise says, I saw your video on Wyoming Public Television. That was a good presentation. Which was your presentation ahead of time.
Thank you very much. I would actually, unless there's objection, thank you very much for providing a public forum for our meetings and our work. We appreciate that. We want folks to be interested and to pay attention. I have a 2-part response. One, I don't think that that's a problem to make sure it's easier to find information about this particular meeting, and I'm going to direct Steve Moise to do that based on your suggestion. And then for materials over a decade, I suppose if somebody, it's all public information, if there's someone who's looking for something that's not a privileged document, today I don't think that would be the case. They would just come to staff here and ask for that particular document, and we have a responsibility to get it to them. I just want to make sure that we're clear that those are both 2 things, 2 suggestions that we can absolutely make happen, and give a sense to those viewing today that that should be easy, not hard. Yes, sir.
Can I clarify my comment about, there were reports on today that on items, And it's hard to follow even when you're here because you don't have the report in front of you. When you say the private industry, this committee's done this or that, and you're looking at even I'm sitting here listening, but you have no reference to it as a public member. And some of it may be confidential, and that's the reason I've been told it's not made public, but some things should be available because if you're watching a wide shot, which I was watching, and you're hearing a lot of information, but what's the value to the public if they have no reference to that information? I did that, the reports they're giving are public reports, and they should be, what have you done this quarter should be available to the public.
I see a lot of hands, I'm getting to them, thank you. All right, I don't know who was first, do you mind if we respond? Evan or Charlie, you wanna go to Charlie?
Sure, Governor and Mr. Knoll. So we do, on a monthly basis, provide an extensive packet of meeting materials to the public. I'm glad to walk you through on how to get that. But I would put the information that we put out every month against anybody in the country. We are very transparent, and I'm sorry you're not able to find those reports, but they do exist. And usually the only thing that is excluded from those reports would be a late edition or things that are proprietary, trade secret, and not available on a public basis.
Can I respond to that?
Yeah, just a second, I'm trying not to have a total debate, and I think I might be able to do this, I think. So I get on websites all the time. They're awful. And I would give state government, what do we give ourselves? A C minus? It's bad. And that's if I'm being generous. So if you're a public member, a regular citizen, right? And you're trying to navigate any of this, it's much harder than you might think. So I would defer that if we get anyone who comes to any of these meetings and asks us to take a look about how we might make it easier, the response should always be, and unequivocally be, yes, we will. This group has worked tirelessly. I'm one of the newest persons here. They've worked diligently for years, I think, to improve access and to figure it out. But we don't need to be, you weren't, but I want to make sure that we don't need to be defensive about that. And we ought to be entertaining every single comment about things that we could do better. I take that in that vein and spirit. I would ask you, Charlie, to take a look and see if you can make it a bit better. And I'll just give you a case in point. I just had one of my larger departments who really needs to have a lot of public engagement, and they love their information on the web, and I can't find any of it, neither can any other constituent. And sometimes we can't see the forest for the trees, so that's how we improve ourselves. So I think I can balance it for both. We will take a look, and I will hope that at the next meeting, you'll let us know if you see any differences or changes, and I would invite you to take Charlie up on his offer, which is a good offer, which is show us where that's difficult, and we can make changes unless it's proprietary information, and then we can point that out. And then one last thing, sir, thank you.
I want to say that staff has always been very responsive to
Excellent.
me. Anytime I email them, they email me with work. It's not me. It's the other people that are out there that want to know, and are you gonna walk 100 people, 1,000 people, 10,000 people through it every time? And I have a goal to make as many people I know aware of the State Investment Council and what, the families in northern New Mexico, if you talk to them, they talk plant grants and all these things that were supposed to be to their benefit, and they feel there's no benefit. And I said, well, you've got to go put it on the table of the State Investment Council, because they're managing your money to your benefit. And if you're not feeling a benefit of that, well, that's where you go to take it to. Okay. So that's what my feeling is.
I appreciate that sentiment and that advocacy. Thank you for both. Any other public comment? Seeing none, I would entertain a motion to adjourn the meeting. Senator, so moved. Harold is a second. We have many other seconds. Any discussion? Seeing none, all those in favor say aye.
Aye.
Aye. Any opposed? Any abstain? Motion carries. Thank you for a good meeting. Thank you, Scott, for your presentation. Thank you, Senator.